Seniors, here is the dilemma. We work most of our life to pay off our mortgage. We pay off our mortgage. We have no monthly payment, but we got the majority of our assets tied up in equity in the home. As we get older, it's more difficult to access those funds, and it's probably smarter to access those funds than to be taking money out of the market at a time when you can least afford to do that, because maybe the market is down, or maybe the market is going up and you don't want to take the money out of the market because it's working for you. But the equity in your house is just sitting there. Now, this presentation is designed for you. Whether you're a senior or you're a loved one looking after a senior, I'm going to talk about the dilemma that we're in as seniors, because I'm 63 myself, and I want to talk about some solutions. So with that said, let's get started. The first thing I want to talk about are the challenges that seniors face in retirement. We're living longer. You may not know this, but back in the 1900s, we were expected to live till maybe we were 40 years old. Back in the 1800s, we might die when we were in our 30s. This is why people got married so young and started families. But with artificial intelligence and biology intersecting right now, it's moving faster than you might think. Now, living longer isn't necessarily always a great thing if you're sickly, or, if you're confined to a wheelchair or not able to take care of yourself, or more importantly, you've run out of money, right? But the idea is we want to live longer where we are healthy. And I'm very much into artificial intelligence. In fact, I was a contributor to a strategic AI curriculum at the University of Colorado Springs. And there is billions of dollars going into healthcare right now to help us live longer, but more importantly, live healthier, not getting cancer, not getting Alzheimer's. These are the things that they're working on. So good news is we're living longer. However, many times seniors they didn't plan on living till they were 90 or 95 or 100. And they're outliving their savings, and they've got the majority of their money tied up in their home. And at that time, you have lower income. I mean, our prime earning years are where we're in our, between 40 to 60 years old. And after we retire, we kind of hunker down. We go on a fixed income, we get Social Security, and, we do what we can to make our dollar stretch as much as possible. But with that said, when you have lower income, if you do try to, access the equity in your home, you're not able to qualify for it often. Now, even if you have $10 million in the bank, I still have a solution for you. But for the most part, most people do not. There's unexpected medical events. I mean, I'm 63 right now. I feel great. I work out 4 times a week. And, I try to take real good care of myself. I had a heart attack about 5 years ago, and it kind of shocked me into reality. But as we get older, even though we might feel great right now, we know that we might have some unexpected medical events coming up. And if we're broke, or we're living paycheck to paycheck from Social Security, maybe a small pension, having an unexpected medical expense could be devastating. We have uncertain market stability. This is January of 2024. Over the last few years, the stock market, was terrible. The last thing you want to do is take out money out of the stock market to fund your retirement when you least likely could afford to do it. Maybe your stock has gone down in value, and now it's also creating a taxable event. And for the most part, we don't have the ability to qualify for a traditional loan like we do when we're younger. We know that older Americans are living longer. In 1960, men who turned 62 were expected to live about another 15 years. But by 2040, they're likely to live for another 22 years. I would argue maybe even longer. For a woman, life expectancy, the gain during that same period of time would be an additional 4 years on top of that, 15 years, because women live longer. And the earliest eligibility for Social Security is 62. They didn't expect us to live this long. This is why Social Security is in a bit of a pickle right now. But you see, the majority of that money that's in the Social Security fund could be easily fixed if they could bring down the cost of health care. So seniors are outliving their savings. 48% of retirees fear outliving their savings due to insufficient retirement funds. 57% are surprised by high interest retirement costs. We recommend $555,000 or 10 times the median income. Majority of retirees carry debt. They have credit cards, they have mortgages, car payments, medical bills. This was no problem when we were working, but when we retire, what I see a lot of times is that seniors, are barely able to make it, and they're using credit cards for emergency purposes, and now that credit card debt is just building up exponentially to the point to where, now they're starting to get bad credit because they can't afford to pay this card. So because we have lower income, 11.5 million older adults, 72% won't qualify for public assistance, facing challenges in covering long-term care expenses. Now, this is the thing. We make too much money to qualify for government programs, but we don't make enough money to take care of ourselves. In 2033, these adults are going to have less than $65,000 in income in annualized assets, the average needed for private assisted living and medical care. Even if these seniors sold their homes, 6.1 million, 39% of them would still have a lack of resources. So the key is, how do you get money out of the asset that you have that has the most amount of money into it? Well, the picture on your left there is a rubber $100 bill that I often use to try and explain to people or, give them an idea of what equity is. People they take pride. They've got a lot of equity in their home. But imagine that $100 rubber $100 bill being the equity in your home. You cannot spend a rubber $100. No matter where you go, somebody might give you a few pennies for it, but they're certainly not going to give you $100. That equity that's represented in that $100 rubber bill needs to be turned into actual cash. And there's a couple of ways to do that. One is a cash out refinance, but again, we're not making as much money. So the chances are that we're going to do a cash out refinance is highly unlikely. Also, if you do have a loan, you probably have a really great interest rate, down in the 3s or something like that. And interest rates, as we know, over the last couple of years have gone way up. So a cash out refinance is not the solution. We have what's called a home equity line of credit. This is where you keep your mortgage and you get the bank to give you a second. It's a home equity line of credit. It's like a credit line. Now, again, problem with this is that you have to qualify for it. You have to prove to the bank that you have enough money that if you do pull the money out, that you have the ability to pay it back. And this is often not the case. You might be making a comfortable living where you can support yourself with $5,000 or $6,000 a month, but it's not enough to qualify for a home equity line of credit, because they're going to take 50% of that $5,000 a month, which is $2,500, and then they deduct things like property taxes, even if you don't have a mortgage at all, property taxes, insurance, and you have to have enough income to show that you can pay that loan back. And that's often not the solution. And there is the reverse mortgage. Now, before you form an opinion and automatically tune this out, please, I want you to hear me out. Because most people that have a negative opinion of the reverse mortgage, and I've talked to hundreds, if not thousands of them, it usually traces back to something that happened before the mortgage collapse. You have to remember that before 2008, you could be flipping burgers at McDonald's one day and be a loan officer the next. So there was all these characters that were in the business that shouldn't have been in the business. It's just they saw an opportunity to make money, and it didn't take anything other than to be able to get on the phone. And they often took advantage of seniors by not explaining properly how the reverse mortgage works. The reverse mortgage, by the way, the technical term is home equity conversion mortgage, or HECM. I'll show you that in a minute. So with a reverse mortgage, you never have to pay your principal and interest payment again if you don't want to. And with a reverse mortgage, you do have to pay your property taxes and your insurance. So loan officers, what they were doing is they were putting people in reverse mortgages, and they weren't telling the seniors that they had to pay their property taxes and their insurance. Seniors were getting bills thinking, oh, this is taken care of. We have a reverse mortgage. And then 3 or 4 years down the line, they were getting notices from the county that they were going to foreclose on their home, because regardless of whether you have a reverse mortgage or no mortgage or a traditional mortgage, you have to pay your property taxes and your insurance. And the loan officers were not explaining this to the seniors. The other situation I found was that they weren't letting seniors know how urgent it was that once they get the reverse mortgage, that they get a trust, that they get, power of attorney and a will put together. Because when you have a reverse mortgage, you can still give that home to your kids. They have a year to be able to either sell it or refinance it. But if the home is locked up in probate during that year period, well, the time is ticking, and the kids can't do anything with the house. So I always insist on my clients making sure you talk to an estate planner when you do get a reverse mortgage. But let's go back to the home equity line of credit. So the home equity line of credit, let's say you have a house that's worth $1 million and you owe $300,000, and you have a $300,000 line of credit through the bank. Well, that is not guaranteed, folks. In fact, after 2008, all of the banks they froze all the home equity lines of credit because they knew the market was going down. I had clients that had $200,000-$300,000 in their line of credit, and all of a sudden it was cut off and they had nothing. To them, it was a savings account, but it was a way to access the equity in their homes. But banks can turn that around on you. They just did it again when the pandemic hit. They froze all the home equity lines of credit. So they have the ability to do that. With the reverse mortgage, they do not. It is federally insured by the FHA, right? The Federal Housing Administration. So the government actually created this loan, and it is insured. They could never take away your home equity line of credit with a reverse mortgage if we set it up at the beginning to have a home equity line of credit. So I want to talk about the timeline, how this all started. Again, they weren't expecting seniors to live as long as they were. And what was happening is we started living longer because of medicine, penicillin, all these antibiotics. And so in 1961, the first ever reverse mortgage was issued. In 1989, it was actually issued under FHA and insured by FHA. So it became what we call a non-recourse loan. So let's say you had a home that was worth $500,000 and something happened. There was a fire or an earthquake, and now your house was worth $200,000. Not as far as the banks were concerned, because it was insured by the federal government. That home was still worth $500,000 as far as the banks were concerned. So as long as you were planning on rebuilding the house, you got to keep that house, you got to keep the mortgage. But let's say the house was paid off and you wanted to walk away from the home. The bank could not paid off, but if you still had a mortgage on it and you walked away, the bank could not come after you for whatever the difference was because it was insured by FHA. In 2001, they put in counseling procedures and policies just to make sure that the seniors were doing this counseling and that they were aware of the type of loan they were getting into. In 2009, the first baby boomers started retiring, and now they made the reverse mortgage available to people who wanted to buy a home. Let's say you wanted to buy a home that was $800,000 and you only had $500,000. You could come in and put that $500,000 and the other $300,000 would be provided through the reverse mortgage. In 2015, they changed it a little bit to where now you have to qualify to make sure that you can pay for the property taxes and the insurance. Before it was, you just had to be 62 and had enough equity. Now there's a little financial assessment, but even if you're making just Social Security, there's a really good chance that's not an issue. And then 2017 was the final rule. In 2023, the loan limit in the high cost areas like Orange County, San Diego, Los Angeles County, actually Los Angeles and Orange County, I think San Diego is a little bit less. Now it's like 1.15 million if you live in a high cost area is what the loan limit was raised to. So some of the biggest benefits of the reverse mortgage is it locks in the value of your home, giving you security in your equity. We know about all of the natural disasters that are going on. I don't know, that maybe there's something happens in your neighborhood where the value goes down because of the economy. It doesn't matter because this loan is federally insured. And as far as the bank is concerned, it is worth what the house was worth minimum when you got the loan. Let's say you have a home that's worth $1 million and the home goes up to $1.2 million. Well, guess what? That other $200,000 that belongs to you. It doesn't belong to the bank. It still belongs to you. But if the value were to go down, it's insured. So there would be no recourse on you. And you get to stay in that home forever. You could never have that home taken away from you unless you weren't living there. And of course you have to pay your taxes and insurance. So it eliminates the worry of a monthly payment. There is no principal payment, but if you wanted to pay interest on it, you could. And if you pay the interest on it, and we have it set up as a line of credit, the moment you pay that interest, it immediately becomes a line of credit that you can tap into whenever you need to. But you don't have to make the interest payment. That's a beautiful thing. Let's say you want to go travel the world for 3 months and you don't want to pay any interest or anything. You just want to go enjoy yourself. With a reverse mortgage, you don't have to pay any principal or interest, zero. You can if you want to, but you don't have to. It reduces the worry of unexpected medical expenses because now you've got a line of credit that you know can't be taken away. So if you have some sort of an emergency, you can tap into the equity into your home. It gives seniors more purchasing power if you're buying a home. Let's say you have a $1.5 million home and you want to, get yourself a little condo or a little home in a 55 or older community. You want to downsize. Well, let's say that you get $1 million from selling that home and you don't want to use all the $1 million to buy the new place. You can put $500,000 down and get a reverse mortgage for the other $300,000. I mean, it just depends on how old you are, how much the house is that you're trying to buy. And, because the older you get, the less equity you're required to maintain. So in other words, if you're 63 years old, you might have to put a little more down than if you were 73 years old. If you're 73, they wouldn't require you to put as much money down. It's a guaranteed line of credit with a growth rate of 5%. Again, we need to make sure when we set this up, that is chosen. Tax advantages of the reverse mortgage is that if you decide to pay the interest on that loan, you get to write off, some of that interest off your taxes. So you can pull money out also, and it's not a taxable event because technically speaking, you're borrowing it against your equity, you see? So you don't have to pay the taxes if you take out $100,000 because you need to do a remodel or something like that. If you were to pull it out of the market, you may need to do that. And if you do decide to pay the interest on it, it just keeps adding up and your line of credit grows. It's a tremendous age-in-place strategy for seniors and their loved ones who are taking care of them. It's very expensive to go to assisted living. I know the majority of the seniors that I deal with, they just want to, stay in their familiar surroundings where they have all their neighbors and, Their family knows where they're at. It's their home. That's where they want to stay. Maybe they have somebody that comes in occasionally to help. It's designed to make it easier for you to tap into your equity. It's very easy to qualify for the reverse mortgage. Also, remember, I told you it's called a HECM, home equity conversion mortgage. Even if you have a low credit score, chances are you're going to qualify. The loan is based on your age, your equity, and the value of the home. And I can do a proposal for you without pulling your credit to let you know exactly how this is all structured if you decide you want to do that. There is FHA counseling. It can be done right over the phone. Part of the proposal, when I get it for you, is going to have the numbers of the different FHA counselors on there. You just set up an appointment. They'll get on the phone. It's about an hour long. From what I understand, it costs anywhere from $150 to $200, depending on who you're using, but it's well worth it. And a reverse mortgage usually takes about 45 to 60 days. Primarily because there's a little bit more to it. You have to do the counseling. We want to get you the proposal, but also because, there's a lot of seniors that are not moving as fast as they used to. I have a client right now I'm doing a loan for in Florida. She's 97 years old and she is as sharp as a tack. But, I have other clients that are 80 that they move it a little slower. They may not be able to use the computer. It may take a little bit more of hand holding. And collecting documentations. This is why the 45 to 60 day period is essential. But if you have somebody helping you, it can go quicker than that. So in 2022, there were 18 climate disasters and over $175 billion in damage. Over 40% of homeowners, 42%, are concerned that weather events such as wind, rain, ice, hail, flooding are going to damage their home within the next 3 months. So this eliminates the worry about your monthly mortgage payment. As I told you, most loans require mortgage payments to repay the borrowed amount, not the reverse mortgage. Reverse mortgages differ. The interest is accrued to the mortgage balance with an option to pay the interest to avoid the mortgage balance increasing if you want to. But the way FHA has got it structured, the home is appreciating faster than the loan amount is increasing because of that interest that's added on there. And I'll show you what I'm talking about in a minute. The reverse mortgage's balance is due upon selling, moving, or death. Now, here's the thing. You just have to live in your home 6 months and one day out of the year. I had a client that had a place in Chicago, and they had a place out here in Lakewood, California. They spent their winters out here in Lakewood, and then they spent their summers back in Chicago by their family. And they wanted a reverse mortgage on their property in Lakewood. And I said, well, do you stay there at least 6 months and one day out of the year? They said, yes. I said, okay, perfect. So we got them a reverse mortgage. The repayment is not expected to happen until you either sell the house or your heirs sell it, or you refinance it. If you go into long-term care, then you would need to sell the home and pay that loan off because you have to live in there at least 6 months or one day. And remember, your heirs have 1 year to either refinance it or sell it if you were to pass. Now, there's no mortgage payments while you're living in the home. It's not required, but you can pay the interest. It offers extra budget flexibility while you're living there. I mean, it's incredible. I mean, you need a new water heater or something like that. You got your line of credit. You don't have to break the bank to be able to do it. You just utilize your line of credit on your reverse mortgage, as long as we've got it set up that way. Reduces the worry of unexpected medical expenses. According to recent estimate by Kaiser, seniors on average spend about $5,000 per year for out-of-pocket healthcare expenses not covered by Medicare. This gives seniors stability when they need it the most. Economic stability entails essential resources for a healthy life. Affordable housing, you got to be able to live, where you're living and still be able to eat a decent meal and be able to see your family. Economic peace of mind. You're not, worried that somebody's going to kick you out of the house. It doesn't matter if you live till you're 120. you cannot be removed from this home unless you're moving out voluntarily, and then they would, call the loan due. You can explore and travel, maybe take some of that money and go see the world. It eliminates the need for financial support within the family. If your kids are trying to help you out with credit card debt, because this is what happens. I see it all the time with seniors is that, they're doing okay. And then all of a sudden, like I said, their water heater goes out and they put it on a credit card. Well, they're on a fixed income and that's collecting interest. And then next thing you know, maybe they need a new washer and dryer, and they put that on the credit card. And this is all collecting interest, and it just can spiral out of control. With the reverse mortgage in your line of credit, you don't ever have to worry about it paying it back. See, it has a guaranteed line of credit with a growth rate of 5%. Again, this is if we structure this at the beginning. The reverse mortgage offers that line of credit for the seniors that have enough equity. And if you decide you'd like to do this, we do a proposal. I'll show you how all of this works for your individual situation. Line of credit is permanent and cannot be revoked. And unlike the home equity line of credit, it's federally guaranteed. I've already explained that to you. Many tax advantages of the reverse mortgage. Like I told you, it's not taxable when you use some of that line of credit. It also doesn't affect the amount that you're getting from Social Security or Medicare. I mean, if you're using your line of credit that doesn't have to be paid back if you don't want to, it's not going to affect how much money you're getting from Social Security or Medicare. There's no principal payment ever required. Interest accumulates on the loan. I'll show you how that works. But it's increasing on a smaller amount than the value of the home is. So the home is usually always going to outpace whatever the loan amount is. Unbeknownst to many, there's an option to pay the interest monthly, which I explained to you. And making the interest payment also gives you a tax deduction now because you're paying interest, you see? So it's a tremendous age-in-place strategy for seniors. Familiarity and comfort, staying in the same home provides that for the senior. Independence allows you to, be around your neighbors and, do what you've been doing for decades, right? And gives you that connection to your community and support. It's designed to make life easier for you. It's not limited to financially strapped homeowners anymore. I can't tell you how long this loan, people have, they looked at it like it's the loan of last resort. And God bless us that, we do have this because there are seniors. I've had clients that are making $2,500 a month. And by the time they pay their property taxes and their insurance and a few small little bills, they're barely able to eat. In fact, I did a reverse mortgage for one of my clients that lives in Aliso Viejo in a senior community. And if it wasn't for Meals on Wheels, she would have literally starved to death. She's got the reverse mortgage now and she's living her dreams. She's able to enjoy the rest of her years. Home equity conversion aids in bill payment and safeguarding your savings. In other words, we're not yanking money out of the bank or out of the market at the time when you can least afford to do that. So seniors in their early 60s and early 70s can use a reverse mortgage to fund cushion investments. The funds will cushion investments as markets decline, postpone Social Security claims. Like you don't want to take Social Security until you're 67 years old. If you take it earlier than that, you get less money. If you have a reverse mortgage, you don't need to take your Social Security until you turn 67. Here are some of the facts about the reverse mortgage. You need to be at least 62 years or older. It used to be both people needed to be, but now only one person needs to be over 62. But the amount of equity required is going to depend on whoever the youngest is in the marriage. You must live in the home more than 6 months in a year. I already told you that. The homeowner or the heirs, you get to keep the equity. This home gets sold and the loan gets paid off and the rest of the money belongs to whoever you're leaving it to. You just want to absolutely make sure you have a trust, a will, and powers of attorneys in place so your heirs don't skip a beat. Depending on the age, you need to have, like if you're 97, like my one client, you don't need to have as much equity to be able to do a reverse mortgage. Whereas if you're 62, you need to have more equity. U.S. citizenship is not required, but non-U.S. citizens without lawful residency status are not eligible. In other words, if you're here legally, you own a home, and you're of age, you have the equity, you also can have a reverse mortgage. Super easy to qualify. If you have a condo and it's an FHA reverse mortgage, then the condo needs to be FHA approved. If not, we can try and do what's called a spot approval. But if all else fails, there is other proprietary reverse mortgage products for condos like that. Family residence, it doesn't matter. It doesn't need to be FHA approved. So here's some fiction about the FHA. Home must be debt-free before a client can qualify. Not true. I just explained it to you. Like, as long as you have enough equity in the home, let's say you had a $200,000 loan, your home was worth $800,000. When you do the reverse mortgage, they're going to pay off that $200,000 loan, and now that's going to be part of your reverse mortgage, and you're not going to have a mortgage payment. The bank owns the home. Well, the bank owns a home when you have a regular mortgage too, but they own it along with you. The bank does not own your home any more than it does on a forward mortgage when you have a reverse mortgage. If the home goes up in value, that equity belongs to you, not the bank. The only thing that belongs to the bank is the money that you owe them. Any more of the equity belongs to you. And again, it's guaranteed that if something were to happen, it would not go down. The heirs, another myth is the heirs incur any outstanding mortgage debt. Well, they would if they're only paying off the mortgage. That's the mortgage debt that they incur that has to be paid off, and then they get to keep the rest. But if you had a $500,000 reverse mortgage and the home was only worth $400,000, they could not come after the heirs for whatever the balance is, because remember, this is insured by FHA, so it is a non-recourse loan. So this was an article. I often get seniors to say, I want to leave my kids my home. Well, this article in the Wall Street Journal actually says kids don't want your home. They want what your home represents, which is the equity that's in your home. What often happens with your heirs is, they have to renovate the property. They have to find a realtor. This all costs money to be able to do this, right? To renovate. And then now you might be arguing with the other heirs as to how much you should sell it for. And then when you do sell it, it's a taxable event and you have to split up the money with your kids have to split money up between them or whoever you're leaving it to. So kids don't want the home. They would rather have money. So, I think most importantly, your kids want you to be happy. Nobody wants to see their parents. Well, you know what? I can't say that because there's some terrible people out there. Fortunately, the majority of people are really good people. And the chances are your kids don't want to see you suffering, living hand to mouth, barely being able to feed yourself and fending off bill collectors. They want you to enjoy the rest of your life. And the good news is you still are probably going to be able to leave them that home. So let's talk about, how this works as far as like what we call the amortization. So in this case, if you see here where it says property value, we're starting with a home that was worth $800,000 in this example. Now, the mortgage that is on this $800,000, we're taking an example of $313,400. That's how $313,400. That's the first year. These are the metrics. But then over 10 years, the home goes up the FHA calculates that your home appreciates a minimum of 4%. In California, obviously, it's been much higher than that. In lots of parts of the country, it has. I mean, in 2000 and 2001, my gosh, it was going up 15, 20% a year. But I would say normal is 5 to 6%. They're only calculating 4%. So after 10 years, that $800,000 loan, it's $800,000 property is now worth, close to $1.2 million, $1,185,195. Well, guess what? That appreciation there, it doesn't belong to the bank, it belongs to you. Now, if you didn't make any mortgage payments, that interest is getting added on to the loan. Instead of it being $313,400, now it's up to $585,000. But remember, again, the home appreciated. The loan went up, but the home also appreciated. Over that 10-year period, you would have saved $180,000 in monthly payments, and your line of credit, if you only started out with $5,000, would have appreciated. And believe it or not, even if you made no payments, because the home is going up faster than the loan is, your equity actually is rising. The equity, when you did the reverse mortgage, is estimated at $486,600, but now you've got almost $600,000 worth of equity, even though you didn't make one payment. You saved that $180,000 because the value of the home is going up and the loan is going up. You're usually never going to surpass the equity. It's actually going to wind up being more. So guys, this is it. I just want you to know that I would love to talk to you about this. If there is anything, I'm going to enlarge my face here. So if you have any questions about this and you're watching this on YouTube, send us a message. If you are on YouTube, or you can also email us. It has my information on this last slide, but it's very difficult to read. And we'll put it on this email. If you email team@krevoyteam.com, team@krevoyteam.com, we can set up an appointment. We can do a Zoom meeting. We'll just talk. We're not going to pull your credit, I want to find out whether or not, first of all, this might be the solution for you. If it is, then we can go ahead and get a proposal, again, without pulling your credit, to tell you how this would all work out. Now, if you agree at that point that this is something you want to pursue, then you schedule the counseling, and then we start the loan process. So team@krevoyteam.com if you want to email me. But I've had the same phone number now for darn near 25 years, and it's 949-735-4009. I'll also put this here, or if you wait till the end of this video, it's going to have all of our information, mine and Shane's, but it's 949-735-4009. I would love to talk to you to see if I can help you. All right? I hope that you got something out of this, and hopefully we'll talk. Take care.